I'm Puja Sharma of IBS Intelligence, and you're listening to the IBS iViews podcast. With me is Mahesh Shukla, founder and CEO of PayMe. Welcome to the podcast, Mahesh.
Thank you, Puja.
Mahesh, for our listeners, could you briefly share how PayMe, a digital lending platform, is different from its peers?
The fintech boom has come to India, and lots of fintechs they emerge from different points. All of them had their entry points. Some of them started from payments, some of them started from UPI based transaction, cards. At the end, lending was intended to happen because this is one core business through which any financial institution makes money. So when we were thinking about PayMe, so PayMe was not built for something which was already existing. So there was a pain point which I have seen over my career. I have been understanding the ecosystem, the borrowing ecosystem when I was too young. So I have seen the gaps from my because I'm from a rural place. I am from a village. I've migrated from a village to a metro city now. In villages, people are unaware and they end up losing everything just for a small borrowing that could be like say even $100, and they are paying continuously. They're just paying the interest. They lost their cattle, they lost their land sometimes, and they get bullied also in public if they don't pay on time. This all has happened because in rural places PSCs are leading. There is no private banks out there. So that aggression, that hunger of business is also not there. When I try to understand, when we as a white collar, we are receiving say 100 odd calls every day for loans, for various offers from these private players. But why can't they serve these people, those who are actually in need? That was the question, and that was the pain area which I wanted to solve as an entrepreneur. Before starting this venture, I started talking to banks that what are your pain areas? Why are you not going to rural places? Why are you opening branches to rural places? There actually people are there and they are in need. Then I learned that there are various metrics which are not matching. There are various profit parameters which may get violated if they would open up a branch, because at the end everybody wants profit from their venture. Some of them were like that new to credit people, they cannot be served. That was again big thing because they have a very thin credit profile. They do not manage their finances that well so that they can be evaluated. Second was that the customers are scattered. So if I open up a branch at a rural place, maybe I'm an SDFC, I would not get that much customer which require for my branch to get profitable, right? Some of the customers are living at different places. So that I would say that concentration of customer which is there in metros, that is not there in rural. Again, the ticket sizes, because when a bank underwrites a customer, they would want the ticket sizes to go into lakhs. That is where they would come into profits, because they have some certain expenditures. So the ticket sizes are also not matching, because in rural maybe the demand is just 25,000, 50,000, or maximum a lakh rupees. So by underwriting such tickets, they cannot get profitable. So these were some problems, 5 problems which we kind of collated, and we thought that let's work around this. So one, we decided that we will bring down the customer acquisition cost to the lowest. So for an example, the customer acquisition cost for a bank is 5,000 rupees, 4 to 5,000 rupees. And we have brought it down to below 1,000 rupees. Then again, we will, with the help of technology, we will make small ticket sizes loans possible. Because if the customer acquisition cost is lesser and you have well underwritten that with the use of technology, so that defaults are also controlled as per the provisions, and then you have slight margin also there, then you can underwrite the small ticket size loans also. So how we are different, so we have solved all these problems now, and the intent was that okay, there has to be 3 to 1 process, 3 minutes onboarding, 2 minutes underwriting, and 1 minute disbursal. So it's not that the customer has to kind of chase you that where is my loan, when I'll get the disbursal. No, it has to be pretty clear. The processes needs to be clear, and they should be getting the amount within the stipulated timeline. So this all we have created. We deal with lots of new to credit people, lots of people who are underserved by the bank. My customer, if I were to split, so my 40% customers are always the one who are first time borrowers to the bank. So that is where we are trying to pay the difference.
What does responsible lending mean in 2025, now that digital credit is such mainstream?
The reach for the consumers as well as the lenders has gone beyond the limit. For an example, we are sitting here at say Delhi NCR, and my consumer could be at Andaman also. So responsible lending means that the consumer who is borrowing is he aware of all the terms what you are trying to offer? Is he or she aware of the charges which you will be charging? As well as, of course, it's a double-edged sword. Lending is a double-edged sword. So when you are offering a loan, do you think the customer is capable of paying it? Like, it's not that you are choking them with the loans, right? Okay, because you want to meet your sales target and you're offering such an amount which becomes difficult for the consumers to pay. So responsible lending for me is that are you well provisioned? Are you aware of the risk as a lender? Are you offering it to the right consumer? Are you in line with RBI's policy? Is the consumer aware of all the terms? So usually what happens, the loan agreements are so vast that they hardly get a chance to read through. They'll just sign it and you've covered everything. But did you try to explain it to them in any form? So that is where, of course, thanks to RBI now, KFS is there, key fact statement. So all the major key terms they can see in the KFS itself. So that is where, as an institution, as an organization, we ensure that we are doing responsible lending. And I think because of regulatory pressure, everybody is trying to follow that.
Regulated fintechs rebuild trust after years of aggressive digital lending. How so?
When digital lending started, as I said, that the reach to the consumers have increased. The new areas have opened where the consumers were not having the access to lending. I would say formal lending. They had lending, but not the formal lending. So that has opened up, and everybody wanted to catch the benefit because lots of alternative data has also flown in terms of UPI transactions data, your transactional SMSs, and with the help of account aggregator and all, it becomes easier to access the direct bank accounts. So if I have multiple accounts, usually when I was applying for a loan or anybody, so I would rather give one account statement which a lender can read. But with the help of account aggregator, now I can have multiple accounts, combine them, read them, and read under the line. I think this is what I can offer to the customer. Maybe he has one account wherein he or she has maintained a larger balance, right? So I can bang upon that. Okay, this is something can be considered while lending to that user. When the aggression started, people were not worrying about the NPAs. People were just focusing on the growth. But now I think COVID was definitely a shock to the financial institution. But it has given the clarity also that where are you heading? Are you just blindly moving towards the growth, or you are actually doing responsible lending wherein your NPAs are provisioned? So if any such shocks come in future, is your organization ready to take that shock? So that is very well learned by the digital lenders now, and the calculated moves have started. And now I think is the time when sensible growths are happening rather than those excess growth.
Thanks to UPI and alternate data, do you think India is finally ready for credit without card?
I think yes. If you see the ecosystem, the infrastructure, UPI is doing miracles. I cannot recall when I spent money through cash. All the payments, even if it's 10 rupees or 1,000 rupees, all the money.
I beg to differ. I do use cash for my daily transactions still.
But it's very rare, and it's easier also. If you see, waiting for the changes, I don't have change. Can you give me a smaller currency? So these excuses have gone now, right? So the digital infrastructure has already taken place. UPI is leading. Almost, I would say 90-95% transactions are happening through UPI. So yes, of course, this is the right time. And I think the plastic money has also taken a back seat since RBI has allowed RuPay card to be integrated with your UPI app. Even people are doing all the credit card transactions through UPI itself.
How do you balance fast dispersal with risk control in tier 1, tier 2 and tier 3 markets?
We are now almost 9 years old organization, and we have seen the worst. Like we have seen COVID, we have seen Chinese lending, and we have seen regulatory pressures. So over the period, we are now a large organization. We have seen the credit gap, and we tried to fulfill. We have also seen an era when we were doing social scoring, which was well actually working, but because of privacy issues, it has taken a backseat. It is no longer accessible. So all the data we have preserved, all the kind of lending we have done, we are now well versed with the models. These models are the one who suggest us that okay, these consumers are worthy. if in case you want to lend to this segment, then probably the risk may go to this level. Say maybe you want to open up, a region which is untouched by the bankers so far. If you want to do that, maybe your defaults would get 2% high. So you well provision it and then put the pricing accordingly and then move. We also have an early warning system which we have built in house. That early warning system helps us in understanding the consumer behavior and their repayment behavior, and it warns us in advance that okay, these are some consumers wherein you need to be much focused because the chances of defaults are very high for them. So this is how we have controlled our NPA, and this is how we are managing post disposals life cycle of the consumers.
Speaking of NPAs now, what does sustainable scale look like for you for fintech that wants to grow without chasing NPAs? NPA, that is a non-performing asset.
For a lender, the biggest worry is NPA. It's not sales, it's not growth. Biggest worry is NPA because this is a kind of business wherein you get to know your consumers post you had disbursed the money, not before that. I mean the behavior. And usually in an industry, say you're selling some goods, you've sold that, you got the money, you can provision your profit after deducting all the expenses. So you are very clear. But here, the behavior starts post a month, and then there is a prolonged period of an year, 2 years, or 5 years, as per the term. So you never know what kind of situation may arise in future. So you have to calculate the industry, the kind of geography the person is working, and the kind of industry he is into. Is there any risk? The biggest challenge may start if the person has lost job. Of course, he or she is not able to pay EMIs, and then your default arises. So that is where we call it a responsible lending also, that when you are into lending, do it very calculative. Provision your NPA because of course it's inevitable. If you are in lending, NPAs will happen. But it has to be well provisioned, and you should be ready to take the shock like COVID or maybe like the Chinese lending things have happened. So similar shocks may come because of XYZ reason. Nobody has seen the future, but yeah, this is definitely going to happen. So are you ready to take that kind of shock? Can your organization absorb that shock? Or are you well provisioned for the NPAs? What if NPAs spikes? So are you backing on your consumer base that okay, no, my consumer is such a good or such a subtle consumer base that okay, they would not default even if delays are happening. As soon as they will get a job, they will pay back. So this kind of provisions has to happen in an organization, those who are into lending.
Mahesh, what is the outlook for 2026 when it comes to responsible lending, especially from the financial inclusion point of view for any common man sitting in a village to access credit?
Lending, of course, is growing in double digits. This will continue to grow. I think we are now saturated with innovation in lending. There is a lot which has happened, and over the period, the consumers as well as the lenders have absorbed it. All the systems are now in place. Like when GST was launched, we wanted to see GST data in underwriting. So that is now a reality. When account aggregator came onto thought, so this is now reality. We can access the bank statements directly from the horse's mouth, of course, from the banks itself. Similarly, KYC is now sorted. Okay, there is a CKYC mechanism which needs to be done. There has been a lots of shuffling over the period, so it is now sorted. So this will bring more and more clarity and more growth. I see lending to grow, say around 15 to 20% annualized rate in 2026 also.
Mahesh Shukla, founder and CEO PayMe.